A guy borrows $3,000 and turns it into $1 billion empire. Another takes $400 and builds $200 million. Sounds like lottery tickets, right? Wrong. These people cracked a code that has nothing to do with luck and everything to do with mastering the one thing most of us run from our entire lives: ourselves. What's up, book lovers? Welcome to Book Zeal. Today we're diving into Market Wizards by Jack D. Schwager, and we're covering 8 of the most important chapters featuring traders who didn't just beat the market. They rewired how they think, feel, and react under pressure. This isn't about getting rich quick. It's about understanding why you sabotage yourself when money is on the line, why you hold losing positions too long, why you exit winners too early, why fear and greed run your decisions even when you know better. We're going to learn how one trader turned self-awareness into his biggest weapon, how another predicted a market crash while everyone partied, how a taxi driver used borrowed money smarter than Harvard graduates, how someone proved that trading can be taught to anyone willing to follow rules. We'll see how surviving mistakes matters more than avoiding them, how math beats emotion every time, and why buying high and selling higher isn't insanity, it's strategy. Here's the thing. Chapter 4 and Chapter 8 are absolutely critical. Skip those, and you'll miss the frameworks that separate amateurs from legends. Each story builds on the last, so jumping around will break the flow. By the end, you won't just know what these traders did. You'll understand how to apply it to your own life, whether you trade or not. Oh, and drop a comment telling me where you're watching from and what time it is there right now. And if this sounds like something you need, hit that subscribe button because we're just getting started. Chapter 1. Ed Seykota. A man sits alone in his trading room. The screen flickers, numbers dance, and in that moment, he makes a decision that will either multiply his account by 10 or wipe it clean. He doesn't flinch. He doesn't second guess. He clicks, and then he waits. Ed Seykota turned $12,000 into $15 million. Not over decades, not through inheritance, through pure understanding of something most people spend their entire lives running from: himself. You see, trading isn't really about the market. Never was. The market is just a mirror. It shows you exactly who you are when money is on the line. Your fears, your greed, your desperate need to be right. Ed figured this out when everyone else was still trying to predict the next big move. There's this thing about winning that nobody tells you. It's not the hardest part. Losing isn't either. It's the waiting. The excruciating, soul-crushing waiting when you've done everything right and the market is doing everything wrong. That's where people break. Not in the loss, in the silence before it. Ed had a ritual. Every time he felt the urge to check his positions, to meditate over his screens like some kind of financial fortune teller, he'd stop. He'd ask himself one question: why do I need to know right now? And most of the time, the answer was ugly. Fear, ego, the need for control. None of those things make you money. They just make you busy. Here's what's wild. Ed didn't just study charts. He studied himself with the intensity most people reserve for their enemies. He kept journals, not about trades, about feelings, about the moment right before he wanted to exit a winning position because it felt too good to be true, about the voice in his head that whispered, maybe just this once the rules don't apply. That voice, by the way, is a liar. It's the same voice that convinces you to check your ex's Instagram at 2 in the morning. It promises clarity but delivers chaos. Ed knew this, so he built systems. Not just trading systems, life systems, emotional systems. He designed his entire existence around one principle: get out of your own way. Most traders treat the market like an opponent, something to conquer, something to outsmart. Ed treated it like weather. You don't fight a thunderstorm. You don't negotiate with a hurricane. You prepare. You adapt. You respect the force. And when conditions aren't right, you stay inside. But here's the thing that really separated Ed from everyone else. He understood that the market doesn't care about your rent, your dreams, your sick kid, your big plans. The market has no emotional obligation to you whatsoever. And once you accept that, once you truly internalize that the universe is not conspiring for or against you, something shifts. You stop taking it personally. You stop revenge trading. You stop trying to get back what you lost yesterday because yesterday is gone and the market has already moved. Honor Point Horn. Chapter 2. Paul Tudor Jones. October 1987. The retail world is about to lose 22% of its value in a single day. Fortunes will evaporate, legends will crumble, and one man is about to make the trade of the century, while everyone else is reaching for the panic button. Paul Tudor Jones saw it coming, not because he had a crystal ball, not because of some secret formula. He saw it because he was watching what everyone else refused to see. The signs were everywhere. Excessive optimism, margin debt at historic highs, that strange euphoria that smells like opportunity but feels like a trap. Here's what most people don't understand about prediction. It's not magic. It's pattern recognition mixed with brutal honesty. Paul didn't predict the crash because he was smarter than everyone else. He predicted it because he was willing to be wrong publicly, to stand alone, to bet against the party when the music was loudest. There's this moment right before disaster when everything feels perfect. The calm before the storm isn't poetic, it's statistical. It's the market holding its breath. Paul trained himself to feel that pause, to sense when confidence had crossed into delusion, when hope had mutated into assumption. He had this thing about losing. He was obsessed with it, not in a fearful way, in a respectful way. Like a pilot who never stops thinking about engine failure, Paul would say defense is 10 times more important than offense, which sounds boring until you realize that the traders who survive long enough to win big are the ones who protected their downside like their life depended on it. Because it does. Not your physical life maybe, but your trading life, your psychological life. One catastrophic loss can haunt you for years. It changes how you think, how you breathe when you enter a position. Paul knew that emotional scar tissue doesn't heal quickly in this game. So he did something radical. He never let himself get comfortable, even when he was winning, especially when he was winning, because winning creates this dangerous cocktail of confidence and carelessness. You start believing you figured it out, that you're special, that the rules don't quite apply to you anymore. The crash came. Markets imploded. Phones rang off the hook. Grown men cried at their desks. And Paul. Paul was positioned perfectly on the short side. He made millions while the financial world burned. But here's the twist. He didn't celebrate. He didn't gloat. He understood something most winners never grasp. Today's genius is tomorrow's cautionary tale, if you're not careful. Paul built his entire approach around one uncomfortable truth. The market will eventually humble everyone, no exceptions. So the question isn't if you'll face catastrophe, it's whether you'll survive it, whether you've protected yourself enough to play another day. He used to say that every trader gets what they want from the market. The thrill seekers get excitement and bankruptcy. The disciplined get consistency and longevity. The desperate get exactly what desperation deserves. Nothing. You don't come to the market with needs. You come with a plan and the emotional detachment to execute it even when your hands are shaking. Chapter 3. Bruce Kovner. A taxi driver walks into a bank and borrows $3,000 on his credit card. Not for rent, not for an emergency, to trade commodities. 3 years later, that taxi driver is managing his own fund. 10 years later, he's a billionaire. Bruce Kovner's story sounds like fantasy until you understand what he actually did with that borrowed money. Most people would have swung for the fences, gone all in, tried to turn $3,000 into $300,000 overnight. Bruce did the opposite. He risked tiny pieces. He learned. He failed small. He survived. There's this myth about trading that the big winners are fearless, that they have ice in their veins. Bruce had something better. He had paranoia, useful paranoia, the kind that keeps you alive. He'd enter a trade and immediately imagine everything that could go wrong. Not as anxiety, as preparation. His first major trade was in soybeans. He bought a position. It went his way, doubled his money. And right there, at the peak of his paper profits, something inside him screamed, "Get out." Not because of analysis, not because of data, because it felt too easy. So he sold. The market collapsed the next day. That moment taught him something most traders never learn. Your gut isn't random. It's processing thousands of tiny signals your conscious mind hasn't caught up with yet. The shift in volume, the odd price action, the way the market feels when it's about to turn. Bruce learned to listen to that whisper before it became a scream. But here's where it gets interesting. Bruce also learned when to ignore his gut, when fear was just fear and not wisdom, when staying in a position felt uncomfortable simply because it was working. The ability to distinguish between useful intuition and destructive emotion became his superpower. He had this rule. Whenever he felt absolutely certain about a trade, he'd cut his position size in half. Because certainty is dangerous. Certainty makes you stupid. It closes your mind to new information. It turns you from a trader into a gambler who's convinced the dice are loaded in their favor. Bruce studied anthropology before he studied markets, and that background gave him a strange advantage. He understood that markets aren't mathematical, they're human. Crowds of people making decisions based on fear and greed and hope and desperation. If you understand how humans behave under pressure, you understand markets. He once held a position for months while everyone told him he was wrong. The fundamentals said he was right, but the market kept going against him. Most people would have cracked, would have assumed they missed something. Bruce just checked his thesis daily and kept holding. When the market finally turned, it turned violently. He made more in 3 weeks than most people make in 3 years. The lesson wasn't about being stubborn. It was about knowing the difference between being wrong and being early. Wrong means your analysis failed. Early means your timing is off, but your direction is sound. Bruce had the patience to wait for the market to catch up to reality, even when reality was taking its sweet time showing up. Chapter 4. Richard Dennis. 2 traders walk into a bar. Actually, they walk into an office, and they make a bet that will prove something nobody believed was possible. That trading can be taught, that you don't need special DNA or Wall Street connections, just rules and the guts to follow them. Richard Dennis turned $400 into $200 million. Then he did something even crazier. He put an ad in the newspaper. Wanted people with 0 trading experience. He was going to teach them his exact system and give them real money to trade. His partner said it wouldn't work. You can't teach intuition. You can't manufacture feel. Richard disagreed, violently. He gathered a group. Some had finance backgrounds, others were professional gamblers. One guy was a game designer. Another worked in security. The only requirement was that they had to follow the rules exactly as given. No improvisation, no personal flair, no trusting their gut when it contradicted the system. They called them the Turtles, because Richard said he was going to grow traders like they grow turtles in Singapore, slow, methodical, in controlled conditions. The metaphor was strange, but the results were undeniable. Within weeks, complete novices were making trades that seasoned professionals wouldn't dare attempt. Here's the secret nobody wants to hear. Trading isn't complicated. It's just brutally difficult. The rules are simple. Buy when momentum confirms. Sell when it reverses. Cut losses fast. Let winners run. A child could understand it, but a room full of adults will find 17 reasons why this time is different. Richard's system had one core belief: trends exist. They persist longer than random. And if you can catch even a fraction of a major trend, you'll make enough to cover all the times you were wrong. It wasn't about being right. It was about making more when you were right than you lost when you were wrong. The turtles struggled at first, not with the system, with themselves. They'd see a loss mounting and override the rules. They'd see a profit and take it early. They'd skip trades that felt too scary. Richard would watch them self-destruct and say the same thing over and over. The system works. You don't. One turtle lost money for 6 months straight. Small losses. Death by 1,000 cuts. Everyone assumed he'd wash out. Then a massive trend emerged in currencies. He followed the rules. He stayed in. He made back everything he'd lost and then tripled his account. Not because he got smarter, because he finally stopped getting in his own way. The experiment proved something uncomfortable. Most people fail at trading not because they don't know what to do. They fail because they can't do what they know. There's a gap between knowledge and execution that's filled with fear and ego and the desperate need to feel smart. Richard eliminated that gap by making the rules so clear there was no room for interpretation. Some of the turtles went on to run billion-dollar funds. Others flamed out spectacularly. The difference wasn't the system. It was never the system. It was who could become robotic enough to execute without emotion while staying human enough to adapt when conditions shifted. Chapter 5. Michael Marcus. Michael Marcus walked into the office of a commodity trading firm with a philosophy degree and absolutely no idea what he was doing. 10 years later, he'd turned $30,000 into $80 million. The journey between those 2 points was filled with more failures than most people accumulate in a lifetime. His first year trading, he lost half his account. Then he lost half of what remained. Then half again. It was like watching someone fall down an infinite staircase. Each step hurt less than the last because there was less of him left to damage. But something strange happened in that destruction. He started learning what not to do. And in trading, that's worth more than gold. Michael had this habit of falling in love with his positions. He'd do the research, build the thesis, enter the trade, and then suddenly it wasn't just a trade anymore. It was his baby, his masterpiece, his proof to the world that he was smart. And when the market disagreed, he'd argue with it. He'd hold on. He'd average down. He'd do everything except the one thing that mattered. Admit he was wrong. There's this moment every trader faces. The position is bleeding. The loss is mounting. And you have a choice. Take the pain now or hold and pray. Michael chose prayer for years, until he met Ed Sikota. Ed looked at his trades and said something that changed everything. You're not married to these positions. They don't love you back. That line hit different, because it was true. The market has no loyalty. Your analysis might be brilliant, but if the market wants to go the other way, it will. And it won't send you a breakup text explaining why. It'll just take your money and move on. Michael started practicing something radical. He'd enter a trade and immediately place his stop loss. Not a mental stop, an actual order in the system. Because mental stops are like diets that start Monday. They sound great until it's time to actually execute. Then suddenly, you've got 17 reasons why you should give it just one more day. His turning point came in soybeans. He was short. The market rallied against him. Old Michael would have held on, convinced he was right, and the market was temporarily insane. New Michael hit his stop and got out. The market rallied another 20%. He would have been obliterated. Instead, he was alive, bruised but breathing, free to trade another day. That loss that never happened taught him more than any win ever could. It taught him that survival isn't about being right. It's about being wrong in a way that doesn't destroy you. It's about positioning yourself so that even your worst-case scenario is manageable. Michael developed this philosophy. Make your losses whisper and your wins scream. Most people do the opposite. They let losses compound into catastrophes while cutting their winners the moment they feel any profit. It's emotional suicide disguised as risk management. He'd watch other traders and see the same patterns he used to have. The refusal to exit, the doubling down, the absolute certainty that if they just hold a little longer, the market will prove them right. Chapter 6. Larry Hite. Larry Hite never wanted to be a trader. He wanted to be a musician, wanted to lose himself in melodies and find meaning in chord progressions. But life had different plans, and what started as a backup career turned into a mathematical revolution that changed how institutional money thinks about risk. Here's what Larry understood that nobody else did. Trading isn't about predicting the future. It's about preparing for every possible future and positioning yourself to survive all of them. He didn't care if he was right 60% of the time or 40%. He cared about one thing. When he was wrong, he lost a little. When he was right, he made a fortune. Most traders are like poker players who win small pots and lose their entire stack on one bad hand. Larry flipped that script completely. He'd lose dozens of small bets without blinking. Then one trend would emerge and he'd capture enough profit to fund a year of losses. The math was simple, but the psychology was torture. Think about it. You're sitting there, watching loss after loss after loss stack up. Your account bleeds slowly. Every morning, you wake up and check positions and see red. Your friends think you're terrible at this. You start thinking maybe they're right. Maybe you don't have what it takes. And then, right when doubt is loudest, a massive trend breaks out, and suddenly, you're up 200% for the year. Larry built his entire system around something called risk management, boring words for a concept that separates legends from cautionary tales. He never risked more than 1% of his capital on any single trade. Ever. Didn't matter how confident he felt. Didn't matter if every indicator on Earth was screaming opportunity. 1%. That was the ceiling. People thought he was paranoid, overly cautious, missing out on massive gains by being so conservative. But Larry understood something they didn't. One catastrophic loss can end your career, but a string of small losses is just the cost of doing business. You can't compound returns if you blow up your account. He used to say that if you don't bet, you can't win. But if you lose all your chips, you can't bet. So the name of the game isn't winning. It's staying in the game long enough for the big opportunities to find you. And they will find you if you're still standing when they arrive. Larry's system was completely mechanical. No discretion, no gut feelings, no overriding the model because the news said something scary. The computer generated signals and he executed them without question. This drove people crazy. How can you trade without thinking? How can you give up control like that? But Larry wasn't giving up control. He was controlling the only thing that matters, his emotional response. By removing discretion, he removed fear, removed greed, removed the voice that says, "This time is different." The system said buy, he bought. The system said sell, he sold. Even when it felt wrong, especially when it felt wrong. Because feelings lie. They lie constantly in trading. Chapter 7. William O'Neill. A stockbroker starts noticing patterns. Companies that explode in price tend to look a certain way before they take off. Strong earnings, new products, leadership in their sector. He starts tracking these patterns obsessively, building databases before databases were cool. And then he does something wild. He builds his entire investment philosophy around one radical idea: buy high and sell higher. William O'Neill broke every rule they teach you in investing school. Everyone said buy low, find bargains, hunt for undervalued gems. William said that's backwards. The best stocks aren't cheap. They're expensive and about to get more expensive because winners keep winning until they don't. He created this system called Can Slim. Each letter stood for a characteristic of winning stocks. It wasn't sexy. It wasn't mystical. It was pure pattern recognition backed by decades of studying what actually worked. Not what should work in theory, what actually produced returns in the real world. Here's where it gets interesting. William didn't care about being early. He didn't want to discover the next big thing before anyone else noticed. He wanted to jump on the train right after it left the station, but before it hit full speed. Let other people take the risk of being first. He'd wait for confirmation, for proof, for the market to show its hand. Then he'd pile in. This drove value investors insane. They'd watch him buy stocks that had already doubled and think he'd lost his mind. Why buy something that's already run up? Why not wait for the pullback? And William would smile and hold his position as it doubled again. Because momentum is real. It's not rational, but it's real. He studied every major winning stock going back decades. Tesla before it was cool. Amazon when everyone said it was overvalued. Apple during its comeback. The patterns were always the same. Strong earnings growth, institutional buying, stock breaking out to new highs on heavy volume. These weren't coincidences. They were signatures. But here's what separated William from the crowd. He was ruthless about cutting losses. If a stock didn't perform within a few weeks, he was gone. No attachment, no hoping, no waiting for it to come back. He'd take his 7 or 8% loss and move on. Because the opportunity cost of being stuck in a loser is higher than the actual loss itself. Most investors hold losers and sell winners. It feels safer that way. But it's financial suicide. You end up with a portfolio full of garbage that you're emotionally invested in and no winners left to carry you forward. William did the opposite. He'd cut losers instantly and let winners run for months or even years. There was this discipline to his approach that felt almost mechanical. But it wasn't cold. It was protective. He understood that in investing, your emotions will bankrupt you if you let them. So he built rules that forced him to act against his instincts, to sell when holding felt comfortable, and to buy when entering felt terrifying. The magic wasn't in finding secrets. It was in following obvious patterns that everyone sees but most people refuse to act on. Chapter 8. Michael Steinhardt. Michael Steinhardt made 30% annual returns for nearly 3 decades. Not by following anyone's rules, not by playing it safe, by doing the exact opposite of whatever the crowd was doing, and having the stomach to endure being called crazy until proven right. Wall Street loved him and hated him in equal measure. He'd take massive concentrated positions when everyone else was diversifying. He'd buy when panic was thickest, sell when euphoria peaked, and in between, he'd suffer through periods where his investors questioned his sanity and his own team wondered if he'd finally lost his edge. Here's the thing about contrarian investing that nobody mentions. It's not just about zigging when others zag. It's about being wrong for long stretches and not breaking. Michael would see an opportunity that contradicted everything the market believed. He'd bet big, and then he'd watch his position bleed for months, while analysts wrote articles explaining why he was finished. But Michael had something most traders lack: conviction that came from deep research and the psychological fortitude to withstand being mocked. He didn't need validation from the market. He needed to be right eventually, and eventually always came. Sometimes in weeks, sometimes in years, but it came. There was this trade in the 80s. Everyone said inflation was dead. The Fed had killed it. Interest rates would stay low forever. Michael looked at the same data and saw something different. He went massively long on bonds at exactly the wrong time. The position went against him immediately. His partners were nervous. His investors were furious. And Michael just kept holding. 6 months later, inflation data proved him right. Bonds rallied. He made a fortune. But that's 6 months? That was pure psychological warfare. Waking up every day underwater, reading commentary about how wrong you are, watching your net worth shrink on paper. That's where most people tap out. Not because they were wrong, because they couldn't handle being early. Michael also had this unusual relationship with information. He didn't want consensus. He wanted variant perception. He'd dig through balance sheets looking for things analysts missed. Talk to customers, suppliers, competitors. Build a picture of reality that differed from the narrative. Then he'd bet on his version being correct. But here's where it gets messy. Michael wasn't always right. He had spectacular failures, positions that never recovered, bets that aged like milk. The difference was how he handled being wrong. He'd recognize the mistake, exit violently, and move on without dwelling. No pride, no ego, just cold assessment and immediate action. His secret wasn't some magic formula. It was simple. Work harder than everyone else. Think differently than everyone else. And when you find an edge, exploit it mercilessly until it stops working. Then find a new edge. Michael once said that the goal isn't to avoid losses. The goal is to make enough when you're right, that the losses become noise, background static in a symphony of wins. Most traders try to be right all the time and end up being mediocre forever. Michael was fine being wrong half the time as long as his wins were massive enough to dwarf everything else. The market rewards those who can endure discomfort longer than the crowd. Who can sit in uncertainty without needing resolution? Who can watch their thesis get destroyed and still believe in the research that led them there? Michael lived in that discomfort for 30 years, and it made him a legend. So here's what all these traders teach us. Ed showed us that we are our biggest obstacle. Paul taught us that defense wins championships. Bruce proved that intuition and discipline aren't enemies. Richard demonstrated that rules without execution are worthless. Michael Marcus revealed that surviving your mistakes matters more than avoiding them. Larry showed us that math beats emotion every single time. William O'Neill taught us that momentum is a language worth learning. And Michael Steinhardt proved that being right alone isn't enough. You need the courage to be right differently than everyone else. These aren't just trading lessons. They're life lessons wrapped in market metaphors. Every principle applies whether you're managing money or managing your own psychology. The ability to cut losses quickly, to let success compound, to follow your system even when it feels wrong, to stand alone when the crowd is screaming the opposite direction. These are human skills dressed up as financial strategies. You don't need to be a trader to understand what these wizards discovered. You just need to be someone willing to look at your own patterns honestly. To ask yourself if you're holding on to losing positions in your life because you're too proud to admit you were wrong. If you're cutting your wins short because success makes you uncomfortable. If you're following the crowd because being alone feels terrifying. The market is just amplified life. Every fear you have about money is just a magnified version of fears you have everywhere else. Every mistake you make in trading is a mistake you're probably making in relationships, career decisions, and personal growth. These traders became legends not because they conquered markets, because they conquered themselves first. And that's what matters. Not the millions they made, the internal battles they won, the discipline they built, the emotional mastery they achieved. That's the real wealth. Everything else is just numbers on a screen. If this hit you somewhere deep, if something in these stories felt familiar, then do me a favor. Drop a comment and tell me which trader's lesson resonated most. Was it Ed's self-awareness? Paul's defensive mindset? Bruce's intuition? Hit that like button if this changed how you think about risk. Subscribe, because we're just getting started unpacking the minds of people who see the world differently. And share this with someone who needs to hear that success isn't about being fearless. It's about being disciplined when fear is loudest. Let's build something here. See you in the next one.